We have Geoffrey Dennis, Independent Emerging Markets Commentator, joining us now. Geoffrey, good morning. Good to see you in. Global uncertainty, it seems like it is abating right now. And the July 9th deadline that there was with regards to trade, that also seems like it is a moving target from here on. Do you think the street will take heart from that? And the way the Wall Street moved yesterday, maybe it looks like we're in better times ahead for global markets and emerging markets?
Better times ahead, I agree with that. I think you mentioned 2 points there. My argument on geopolitics has always been geopolitics will only have a short-term influence on markets unless you get escalation, retaliation, escalation, etc. And if you get a major driving variable of markets that reacts dramatically, and of course what we're watching here is the oil price, which went up 20% and then came down 15%. So right now, it does look like geopolitics is beginning to fade into the background, although it's too early to be sure about that. As far as the tariffs are concerned, I completely agree with you. There is nothing magical about July the 8th, I think it's extremely likely that if Trump wants to do it, given that I think we've had one deal, not 90 as he promised, we've had one deal with the UK, I think probably that deadline will be pushed back. And therefore, although tariffs remain a major risk to this market, I'm not sure we're going to get tremendously bad news on that on July the 8th. But clearly, the market wants to know that, and we will be waiting for it.
Okay. Hi, Mr. Dennis. Great to have you on the show this morning. So the thing is, the market right now obviously is extremely happy because whatever the final outcome on these tariffs is, it may just get pushed back from the looks of it. Do you see any risk at all on the table? I mean, it's almost blue skies. Geopolitics seems to be, at least there's no immediate blowout. Do you see any risks that we should be cognizant of?
Oh, yes. I think there are plenty of risks. And I think they're more developed market focused than emerging market focused because, as you've already said, since I connected with the program, the big driver of emerging markets this year has been the drop in the dollar. And I think that's going to continue. It's been a very, very good year for EM so far, up about 14% in dollar-adjusted terms for MSCI EM. The risks, I think, out there are mainly tied, I think, to the US. Are we going to see a spike in inflation over the next few months because of the tariffs that were imposed earlier in the year? I'm not sure you're going to get a big spike, and I think there will be talk of Fed rate cuts again before too long. I think the other risk that we really have to pay attention to is what is known, of course, in the US as the big, beautiful bill, which is actually going to lead to a very large jump over time in the US budget deficit and also in US debt. And so I think how that plays out will be important. Now, right now, the bond market's rallied nicely and nobody seems to therefore worry about this BBB, so to speak, big, beautiful bill. But I'm watching what happens in Congress, and do we get this thing passed? And does that mean much, much greater risk for bond deals down the road? So I think those are the things I would focus on. Plus, of course, we really need to know that the geopolitics truly has settled down, but obviously that would be another risk as well.
Well, indeed, Geoffrey, good to see you win. The BBB, big, beautiful bill, we'll keep an eye out on that. But just in the near term, all eyes will be on the PCE that's due later this evening. And that's going to be important from what the Fed does as well. Now, I was looking at the Fed futures probability from around 13%, some optimistic view that was coming in with regard to 13% of, the views expected that we'll get a cut in July. That probability has moved to 23%. Maybe it's just kite flying, but if you look at the September meeting, out there the probability is at 93%, and that as well has moved up. So it appears that the market is bracing for rate cuts. Earlier there was some kind of skepticism on that front. How many are you factoring in, and what about the important data point that we're going to get in, the PCE later today?
PCE is very important. The best bet has got to be that it continues the good run of both CPI and PCE data we've had recently. That would be the best bet. I've argued all year for 2 rate cuts. I do think there's a growing possibility that we will get a rate cut in July. And this is part of my argument here. As you well know on the program, Jay Powell, Fed Chair Powell, is under tremendous pressure from the White House and indeed from Donald Trump with all his fatally ridiculous and rather rude comments about Powell. I don't think he wants to say too early that he's thinking of a rate cut. But as you know well, a couple of the FOMC members have come out in favor of a July rate cut. And I don't think it would take much in the way of some more softer economic data. And the July rate cut comes on the table. And therefore, I'm very comfortable with my 2 rate cut forecasts for the year, although whether it'll be July or not, I'm not sure. But I think there's a decent chance it could be in July. All of this is very good for EM, because what the weaker dollar will do, which logically would follow a couple of rate cuts from the US, is push yet more money overseas. And the gap that's building up between EM and DM is going to continue to grow, I think, because the dollar's the big driver here, and the dollar's been very weak, and I think it's going to continue to be very weak.
In emerging markets, I'd like your thoughts on India versus China. The reason for that is because, everyone's wondering whether this trade deal happens or not. There is uncertainty around trade, etc. But, chances are that if it is a moving target, then China stands to benefit a little more than India because of its, exports, or because the bilateral trade between US and China. In that case, would you bet on India's own domestic growth story or China's export story?
Well, China, of course, is not exporting anything like as much to the US as it was, and whether that, the last data point, to be fair, it was only one data point, was very, very weak. And how that plays out will be important, and therefore how the Chinese-US trade talks play out will be very important. But I would say the following. I think the Chinese market is still sort of in recovery mode from very, very weak performance for basically 3.5 to 4 years. It's very cheap. And on any particular good news, whether it's on trade or on the economy, the Chinese market does relatively well. But I stand by what I've said many times, including on this program, and that is that the Chinese economy is very, very vulnerable here because of 2 things. Number one, very slow consumer spending, and number 2, a major drag from the property market. And so I think the domestic risks in China are significant. In India, I just think it's a good story, and you've obviously gone through the numbers before I came, before the interview started. And I think India continues to be a very good domestic growth story. I much prefer India to China. One of the reasons why India has not done as well in dollar-adjusted terms this year is because the currency's been flat, whereas the Chinese renminbi has gone up a little bit. But on the other hand, I think India is attracting overseas interest. And as oil prices having shot up, which is very bad for India, now come back all the way, or virtually all the way to where they were, the high 60s for Brent. That is at the margin very good news for India. So I would watch oil prices for India. I'd watch the geopolitics a lot. But I think the fundamentals in China are significantly weaker than they are in India.
Okay, that's good to hear, Geoffrey. That's really good to hear. By the way, I just want to also put on the table that there were some comments coming in from the U.S. Commerce Secretary, since we're talking about good cues for India. And the U.S. Commerce Secretary has said that the U.S. is close to finishing that trade deal with India. That's what he's been saying. But anyway, more on that later. Geoffrey, to round things up, I don't know if you've had a slightly closer look at the market here in India, the kind of companies that are there in the listed public space. Anything else that you'd like to add in terms of what the pockets of interest could be from a foreign investor perspective?
I don't really focus that much on sectors these days, but my brain, my logic would tell you that I think you've got to be in banks. You've got to be in technology. If the markets are going to do well globally, I think technology will do well in India. The growth story seems pretty good in the sense that there's room also for the RBI to cut interest rates maybe a little bit more. So I would think pockets of consumer discretionary probably look relatively good as well. But to be honest, I'm not doing a lot of work on sectors, but those would be some ideas for you.
Okay, all right. Really appreciate it. Thank you very much for joining us on the show this Friday and leaving us feeling fairly optimistic. So that's a thumbs up coming in from Geoffrey Dennis on India.